Today we're here to listen to Yonah Weiss to talk about cost segregation, and the session will be recorded. So a few housekeeping things is there is a Q&A button on the bottom. So put your questions on the Q&A down there. And if you have jokes to tell, put it in the chat box. Also, I want to just share, this is one of the strategy I use personally to offset all my income tax last year. Since becoming, real estate professional. So Yonah's actually going to get into the meats of how do you actually do it, what is it, and what type of things will qualify. So go take away, Yonah.
Awesome, yeah. Well, thank you again, since we didn't record this the first time. So yeah, this is going to be a lot of fun. Again, make sure you put your questions in the question box. I'm just going to jump right in. If you don't know who I am, Yonah Weiss. Again, I work with Madison SPECS. We're the largest national cost segregation firm, part of a larger company, Madison Commercial Real Estate, but we don't need to talk about that today. We're going to talk about cost segregation, a weird name the IRS gave to probably the greatest tax benefit there is in the entire tax code, especially if you're a real estate owner and professional. What is cost segregation? We're going to get into the nuts and bolts. Depreciation, we're going to cover that, because we have to understand depreciation before we get into cost segregation, because cost seg, and I may just shorten to cost seg, just kind of rolls off the tongue a little better, is just an advanced form of depreciation. We'll talk about bonus depreciation. We'll talk about who should be doing this, when's the best time. I understand some people on this call or people viewing this may be real estate professionals, but some of you may just be passive investors, not real estate professionals, and therefore you have to understand the difference and what the benefits are. We'll do a case study of a multifamily property. In fact, this may be something, one of Elisa's properties. I don't know. Well, maybe we'll have a surprise. We'll see then. Okay, so let's just jump right into it. Okay, disclaimer. I'm not your accountant. I'm not your lawyer. In fact, I'm not even an accountant. I'm not a lawyer. So none of this should be taken as your tax or legal advice. This is educational purposes only. And even though I know more about this subject than 99% of accountants out there, I'm still not your accountant. And therefore, you really need to make sure that this is good. This information purpose is good for your specific situation. What is depreciation? Depreciation means something going down in value, an asset going down in value. But in fact, depreciation from a tax perspective, when referring to real estate, does not even mean that. It's really a borrowed term, because your property, real estate, is a solid asset. And solid assets actually usually appreciate as time goes on. Think about it. Real estate is not really going down in value. It's going up in value as time goes on. Nevertheless, this law of depreciation is a tax deduction that the IRS allows you to take based on the purchase price of the property. When you buy a property, even if it's been around for 100 years, okay, building was built in 1920. You buy it in 2020, you get to start a schedule, a timeline of either 27.5 years for residential properties, including multifamily, or 39 years for other commercial properties. That means that you can now take that purchase price and deduct the entire amount minus land. Land is a little bit, doesn't depreciate, but you can actually take as a tax write-off the entire amount of depreciation, the entire, purchase price of that property. But you have to do it over a long period of time. That's what depreciation is. It's a tax benefit. Now, there's a way, and this is what we're going to talk about tonight, that there's actually a strategy written in the tax code that breaks down the property into many different categories, saying that different things in the building actually have different useful lives. It's not just one big building and it's all 27 years. There's actually a lot of assets that depreciate faster, meaning they have a faster useful life. Therefore, you can take those tax deductions at a faster rate. Now, the IRS does not write in the tax code that you're required to do it this way, because that would just mean less revenue for the US Treasury. But it does mean that if you play your cards right and you actually understand the strategy, you can take advantage of it. And that's probably why they wrote the law, for smart people who know how to use it. Okay, so that's what we're going to do here. So a little overview of depreciation, okay? Here is, let's say you buy a property for $1 million. And Elisa, feel free to stop me at any time if there's any questions of clarification.
Yep. I have tons of questions, but I will leave my questions later. Yes.
You have tons of questions.
Yes.
Okay.
Go ahead. Sorry. Go ahead. Yeah.
Yeah, that's fine. Your questions are probably very good questions. So let's just take a property. Let's assume you buy a property for $1 million. We're going to allocate a certain amount for land, let's say 15%, because again, land does not depreciate. Whatever's left over is called your depreciable basis. That's the amount that you can actually now write off. Again, tax write-off. The entire $850,000 deducting from your income tax. However, you have to do it over a long period of time, right? Straight line depreciation means you're going to be taking a little bit every single year for a 39-year property, commercial property, $21,000, et cetera, every single year. $30,000 if it's a residential multifamily property, $30,909. That means that's your tax deduction. Now think about this. If you own $1 million building, your net operating income is potentially going to be, let's say very, very conservatively, $70,000. Okay? That means you're making a 7%, return on investments from your net operating income after all expenses and everything else. You would regularly take $30,000, deduct that from your $70,000, leaving you with $40,000 approximately. That $40,000, you have to now pay tax on only that $40,000. So depreciation is awesome. It just allows you out of thin air to say, no, I don't need to pay taxes on all of it. I'm just going to pay taxes on some of it. Comes cost segregation, and as we'll see shortly, we can actually take much larger deductions in those earlier years, in the first year or over the first 5 years, which will in turn take that whole $70,000 of tax liability. Don't just reduce it to 40 that you pay tax on, reduce it to 0 that you pay tax on. Okay, so that's really going to be the play over here. Straight line depreciation is great. An advanced form of it, a more like depreciation on steroids, if you will, is actually going to get you more tax deductions and pay 0 tax. So how does it work? Okay, one of the fundamentals of cost segregation is that the engineer actually has to go to the property. Okay, you have to actually view the property and take notes. Why? Because as I mentioned, there are many things in the building that are not part of the main structure. Once the engineer can identify, and this is an engineer trained in the tax code as well, not only in building construction, but also the tax code can come and see that, hey, there's fixtures, there's furniture, there's equipment, there's carpeting, there's all kinds of things in the building that are not considered structural components. All of those things have a value to them. Once I can identify the value of all those individual assets, I can now take that value and deduct it faster over a 5-year period. Okay? That's where reclassifying property, and we are creating a new depreciation schedule. Okay, taking those accelerated depreciation deductions earlier on, which is in turn creating cash flow. Okay, here is just a little bit of a history. This I put in actually for, these are kind of generic slides that I made for a different webinar, but this is good for all those tax accountants out there that want to do a little tax history and see what happened with cost. Where did this come from? It actually didn't come out of thin air a few years ago. This has been in the works for decades already, and it's taken many forms. Many of these court cases, landmark cases, have shaped what cost segregation is today. And part of each one of these cases were different types of assets in a building, kind of an argument saying, well, the carpeting should not be considered structural and depreciated a longer period of time. The carpeting should be at a 5-year period because I replace the carpet every 5 years. So those are part of the things, wall coverings, all different types of things. So if anyone wants to do a little history, a little more studying, they can look into that. Now, here is 2 major categories in cost segregation. Again, as I mentioned, one of the fundamentals is that the engineer goes to the property and identifies the different assets in a building. The 2 main things that they're looking for are what's called 5-year personal property or tangible property, and 15-year property, which is land improvements. Now, these are all directly, spelled out and identified in the tax code under what's something called the MACRS, the Modified Accelerated Cost Recovery System. Okay, so you can look that up, the MACRS, the cost recovery system for all different types of assets, not just real estate. It includes, boats and any type of property that you might own, you can actually take a tax deduction on. So it spells out all the things. The job of the engineer is to go to each individual property and now identify what fits into those categories. So here's an example of certain things in a multifamily building that will fit into the 5-year category. So you have stuff like, think about anything that is in the building that's not part of the structure. Okay, so whether it's carpeting, ceiling fan, equipment, furniture, right, building, shelving, cabinets, all kinds of stuff. Window treatments, blinds, shades, you name it. All of that actually has value. The engineer is going to identify the value of each of those things. As I mentioned, now take that depreciation at a faster rate. The second category, as I mentioned, is land improvements. Land improvements is anything that's outside the building. So whether it's asphalt, paving, concrete, and each one of these things have actually different values to them. So the asphalt, that's in the, the parking lot is going to have a different value than the asphalt, the concrete that's in the swimming pool, and the concrete that makes up the bollards or the, the sidewalk, etc. Retaining walls, landscaping, playground equipment, all that stuff. All of these things have value to them. Identify that value, you can take at a faster rate. Hey, so again, we're going to refer back to this page over here because this page is going to tell you the two different categories. These are the main things that are going to be depreciated faster. And again, in every type of commercial property, there's going to be different things. Okay, so the different things that are there are going to be related to the type of property that you're in. So an office building will have other type of assets. They won't necessarily have, the same things that are in a multifamily building, et cetera. One thing I do want to note, however, is that land improvements can be very extensive, especially when we're talking about a garden style apartment building. And there are certain types of assets, certain types of properties that actually have large amounts of land improvements, like a golf course. Okay, a golf course is a great example of something that is almost entirely land improvements because it's just landscaping and that stuff gets replaced every few years. So that means the value of the property you buy a golf course, the majority of the value in that is actually in those 15-year land improvements that can be accelerated, take huge tax deductions earlier on. Okay, so here's just to recap, what are the benefits of cost segregation? And this is going to be different for whether you're an active investor or a passive investor. And we're going to get to that in one of the coming slides as well. So it's going to reduce our tax liability. Again, making $70,000 instead of paying taxes on the entire 70, we're paying taxes on 40,000 or actually paying taxes on 0. That reduces our tax liability. That increases our cash flow. Okay, if you made $70,000, you get to keep all that $70,000 in your pocket. Now, here's something that I want to just throw out there. We're kind of trained, especially if you worked in corporate America, and at least I know you can speak for this. Probably some of your other colleagues on here can as well. We're trained to think we have to pay taxes because it's automatically deducted from our paycheck. Now, don't get me wrong. Of course, you have to pay tax, but only if you're required to. Real estate doesn't work like that. When real estate, you make money from a property, from an investment, you now have to claim that on your tax return, and you claim that together with the amount of expenses and the amount of depreciation, the amount of deductions. Once you have all those deductions, you can literally have a case where you have all this income and it's all yours and it stays in your pocket. That increases your cash flow. That's the difference between real estate and basically any other type of investment vehicle where you're automatically deducting, okay, from your paycheck, from your work, you're deducting that, giving to the IRS right off the bat, never even seeing your money. But more than anything, cost segregation is the time value of money. Time value of money means $1 today is worth more than $1 5 years from now. Again, we're not creating deductions out of thin air. What we're doing is accelerating those tax deductions. Instead of the whole $1 million and taking a little bit every year for 39 years, we can actually front load 20% of that, let's say 10%, 30%, a certain amount percentage into the first 5 years. And the rest of the 80%, we're going to take those deductions after 5 years up for the next 21 years, or in our 39-year example, the next 33 years. So how we're going to do that is we're taking this money and we're keeping it. We can actually use that now because I'd rather have that now than to pay a little bit every year. If you want to think of it, and I just had a colleague of mine bring this up to me today, that it's very similar to an interest-free loan. But it's not just an interest-free loan. If you actually do the calculations, it's actually the IRS if you want to think of it like this, you're borrowing money, and that money you can now use to invest today, but you're going to pay back after time. So let's take our example, because this is a really cool idea. I never spoke this out, but I think since we're on the line today, we'll just we'll speak this out. Let's say, what?
Love it. Yes.
Yeah, this is new stuff. This is a novel idea that we haven't really discussed before. So you'll hear it here first. Breaking news. Really, what's going on is like this. Let's say you have $1 million property. Let's say $200,000 of that you're taking over the first 5 years. So if I were to offer you $200,000 loan, okay, and you're gonna have to pay back that loan after 5 years. After 5 years is up, you're gonna have to start paying it back over the next 22 years. However, the catch is that it's interest free, so you can now pay that back. At $200,000 over 22 years is going to be a little less than $9,000 a year for the next 22 years. So that's basically how it's going to work. However, it turns out if you calculate the difference of inflation versus the interest rate, which was free, again, it's not an interest rate, but the interest rate of what you're paying it back now later on, and you calculate that versus your tax rate, okay, how much you're paying. Let's say you're at the highest tax rate possible, 43%, right? Or maybe in California, it's even over 50% with combined federal and state. You can actually have a calculation, and a friend of mine sent me this today, like just the calculation of this, that it turns out you have a negative interest rate, which means the IRS is actually paying you to take this loan when it's not even really a loan. They're paying you to take cost segregation, to take those extra deductions. So they're encouraging you to take these tax deductions because it's so much so that they're going to pay you for it. It's pretty incredible when you look at it like that. So it's not just an interest-free loan, and it's not just your own money that you don't have to pay in the first place, but by doing this, you're actually creating more money because you have the time value of money that it's now worth today versus the difference of inflation over time.
This is also why when you win a lottery, you always want to take in the front, right? Like all the lottery winner, if they have consult their legal guys, even though you're getting less up at the front cash value, they always walk away with a cash flow, a cash value, right? Similar concept sure. There. Yeah. Exactly.
Similar concept. And of course, over there, make sure you invest that money also, because most people that win the lottery spend it in the first 12 months of So we're going to talk about bonus depreciation also, but I think there was a slide dedicated to that, so I'm going to save bonus depreciation until we get to this slide dedicated to that. But basically it means that you're taking a huge chunk in the first year. Who should be doing a cost segregation study? Again, this applies to all real estate owners who pay income tax. If you're not taxable, you don't get any depreciation. So one of the main places where this comes up is, obviously if you're a nonprofit organization, you buy a building, you're not taxable, you don't get depreciation. It doesn't help you cost segregation. Again, cost seg is just more depreciation, just extra depreciation. The main place where this comes up and is very common is when people are investing from their retirement accounts. And certain type of retirement accounts, which, by the way, if you don't know how to do this, you should, because the money that's in your retirement account is actually your money. Again, this is another, farce of Wall Street, that the financial planners want to keep your money because, number one, they get a commission on your money, right? So as long as you're keeping it with them, they're taking a cut from it. Number two, they need their money because they're actually investing that money and they're making money on that. They're giving you a portion of that besides for their commission. They're only giving you a portion of what that's making, and they're making more money on that. Yeah. So better actually, to take.
Yonah, it's great that you mentioned that, because we did have a episode that we recorded last week actually on the 401k, solo 401ks, and self-directed IRA. So that's exactly the vehicle Yonah is kind of talking about over there.
Exactly, and very, very, very important. You should be taking advantage of that. You just want to make sure that you're doing it properly and correctly and with the right custodian, the right, people who are handling that, because otherwise you can get in big, big trouble. We actually did last week as well. 2 weeks ago, we have also a weekly meetup every Wednesday night, a Zoom call where we get together and we do some networking also. And we had an expert on this subject as well. And he said one of the biggest things that he sees, because he sees people coming to him after they've already done this and something has happened wrong. He sees that people are putting their money with kind of custodians or programs or salesmen that are kind of selling them a product. And those people don't have any financial, fiduciary background and have very little responsibility on that as well. So he's seeing a lot of people get in trouble with that. It's an unfortunate case. Anyways, the point is, back to our point, some of these retirement accounts, for example, 401k or a Roth IRA, are not taxable entities, which means you can use that money, but you're not going to be taxed on that, but you can't pull it out. Okay. Once you pull it out, you're going to get taxed on it. However, since it's not taxable income, you cannot benefit from depreciation. So cost segregation is not going to be good. So if you're investing in one of these, real estate syndications or something like that in a deal, you actually cannot benefit from cost segregation if your full retirement. So I know some syndicators that, will not take retirement money for that reason. Some that, that take only retirement money and don't do cost segregations for that reason. So, have all ends of the spectrum. You just have to understand who's this going to benefit and who it's not going to benefit.
Yeah. So the trend on syndication world too is sometimes is separate the class of people who's investing. So one position that they allow to invest is a debt position. Like who would ever want to invest at a 10% debt aside from you want a guarantee of income or whatever. So that's actually better. Or versus taking an equity position. But here, if you're investing with a retirement fund, that may be a good option, which is invest in that debt because the debt is taxed at the ordinary income rate. Which is something that you don't want to do with your cash. But with a retirement fund, because you're not getting benefits from the cost segregation, perhaps that's something to kind of think about too. Yeah.
That's actually a really good idea. Yeah, that makes a lot of sense. Great. I'm glad you brought that up. That's a great idea. So let's talk about the real estate professional for a second. And there's more to this than meets the eye. Okay. But we're going to cover the basics right now, because as this applies to you, you should know what this is and how this works. Real estate professional, and this is taken directly from the tax code. Okay, these words here on this page are taken from the IRS. The definition of a real estate professional is either you or your spouse have to have both of the following requirements. Number one, you have to have more than half of your professional time engaged, materially participating in real estate activity. Okay, and those real estate activities are delineated in the second column over here. So you're either developing, redeveloping, constructing, reconstructing, acquiring, converting, renting, leasing, operating, managing, or brokering real estate. If you're doing any of those activities, those are activities that qualify as hours spent in the real estate trade or business. Now, you also need to qualify with 750 hours in order to attain this status. But before we even get to what's the benefit of this, because just having this status on its own does you nothing, okay? Unless you can benefit from it. Now, again, either you or your spouse has to qualify for this in order to get this status. There is one other very important thing with regard to the real estate professional status, and that is you cannot basically, and I've spoken to a number of CPAs about this, that it's almost virtually impossible, if not entirely impossible, to have a full-time job and also claim the real estate professional status. In fact, I heard from Brandon Hall, CPA is a very well-respected CPA in my eyes in the real estate industry, who told me last week that every single court case, where there was an audit and someone tried to claim real estate professional and also had a full-time job, every single one of them, they lost. So basically it's impossible. That's what he's saying.
Well, unless, Yonah, if you work for the government, because they work such a little hour. I've actually known a guy who got audited and actually fight it and won because he logged every single entry of his hours and he works for a government. So his work hours are like 9 to 3.
If the work hours are less, right?
Yes. Yeah. So
That's
his
true.
work hours a lot less, right? So
That's
anyway,
true. Another example he gave is someone who, workout, or someone who is a pilot, for example, where they
right.
may have a full-time job, but they're not really working that many hours. And so they may be able to spend those hours in the real estate as well.
Or
So
like
there are some
maybe,
cases.
yeah, or maybe like firefighters, because typically they are going on shifts, like 40-hour shifts, which is very hard work, but it
Yeah.
frees up them 3 other days, give or take. Yeah.
Yeah, the pilot, the perfect example is a friend of mine, out there in Seattle, also Ryan Gibson, right? He's a commercial pilot and he's a real estate professional. And he told me he got involved in real estate basically when he was a pilot, and he had all these extra hours. He would sometimes stay over 2 days, in a place, and would have no work to do, just waiting there in the hotel or whatever. So he started getting involved in learning about real estate and investing that way. So it's not like you said, not entirely
Very
possible. It's going to be
hard.
very
I
difficult.
didn't even bother when I had a W-2. I'm just like, you know what? I don't want to have anything to do with IRS. I don't even bother. Yes. Yeah.
Right. Now there is one other qualification here, which is that you also have to have, first of all, you have to check a box. Okay. You have to make a claim that you want to take what the next page we're going to talk about is going to be those non-passive losses. Okay. Where the real estate losses we're going to talk about, you can use that, but you also have to have a certain number of hours involved in the property. So you have to have a total of 500 hours actually involved in managing or in properties itself. So even if you have 750 hours of all kinds of real estate, and they're not necessarily your properties, okay, you may be brokering deals, maybe acquiring deals, but actually involved in materially participating in your properties, you have to have 500 hours. But that could go, you can aggregate that across all of your properties as long as you make that election. So back to our point of real estate professional. There's two different types. Let me go back. Okay, I'm getting ahead of myself. I want to define something. What is depreciation? Because we talked about depreciation, but we want to understand what it is from the passive versus active status. Real estate income is considered passive income. Okay? Passive income. Deductions, depreciation is considered passive deductions. Okay? Those passive deductions can offset passive income. That's across the board. Okay. Now, when you are an active real estate professional, as we just described on the previous page, you can now, the one benefit that you have over everyone else in the world is that you can claim the passive deductions as active. Okay. Which means they can now not only, or non-passive is the real term for it, but I like to call passive and active, passive and non-passive. It's the same thing, but you can use those non-passive or those active deductions, right, to offset your active income. Okay, so let me make that clear just with an example. Let's say you have a property that's producing $70,000 of income, and you have $70,000 of deductions from depreciation. You have a wash, you have zero tax liability. But let's say you do bonus depreciation and you're getting a huge amount of tax deductions in the first year. And with that $70,000 of income, you actually created $300,000 of deductions. Now, what happens to those $300,000? The first 70 washes off the income. Okay, so you're paying zero income tax. The rest of the $230,000 creates creates a passive loss. That passive loss doesn't disappear, doesn't go away. It can carry forward in the future years. But if you're active real estate professional, you can now use those passive losses to offset any other active income whatsoever. Okay, so you or your spouse have a W-2 job, right? Or you're a real estate professional and you have other income that's not from your properties. Let's say you have, some sort of commissions, or you have some sort of, fees that you're making, what have you. You can now use those deductions to offset that income as well. That's the beauty of the real estate professional. And again, it can work for you or your spouse, which is great. Now, if you're not a real estate professional and you're just passively investing, okay, here's where this page comes along. This page is talking about someone who's a passive real estate professional, and you're making, meaning you are investing in real estate, right? Maybe passively investing, but you don't qualify as a real estate professional. You can only use those deductions if you have less than $150,000 of adjusted gross income. Okay, if you have more than $150,000, then that just creates a passive loss. And like I said, it carries forward. You can use that next year and the following year, as long as you own the property. However,
Now,
if you have
adjusted growth income, does that, just to kind of clarify for our audience over here, it does include a depreciation, right? Adjusted growth income. Yeah.
Correct.
So great. So as a real estate professional, obviously can look at that, but passive, obviously this means usually just your W-2 job, your income there, unless if you're doing other activities.
Exactly. So if you have less than if you have less than $100,000 of adjusted gross income, you can actually use those passive losses to offset your active income as well. Okay. Once it's over 100,000, it starts phasing out by basically 2% until you get to $150,000.
Which in Seattle, you'd be like in poverty line if you made like $100,000 or less.
Yeah.
It's like $80,000 or something. Yeah.
Yeah, it's pretty crazy. But yeah, that's, you know, the kind of reality that we live in, depending on the locations that we live in and the life, you know, the choices we make, the lives we choose. Tax Cuts and Jobs Act. This is a huge, huge benefit to the real estate world, specifically because, and probably the greatest tax reform that, you know, hit the nation for, you know, decades since the Reagan administration. So what this did, one of the biggest things that this did was it created a new law called bonus depreciation. Now, bonus depreciation wasn't entirely new because it did apply to new construction, but it only applied, excuse me, to new construction at a 50% rate, meaning if what we're doing is accelerating depreciation, right? That's what we're doing with cost segregation. When you did a new construction building, you can now take those construction costs and anything that fit into that accelerated categories, you could take 50% of that as a first year tax deduction. What Tax Cuts and Jobs Act did was it said, no, not only can new construction, you can also do this on any type of property, any acquisition whatsoever, not just construction. So you buy a property, even if it was built 10 years ago, 100 years ago, it doesn't matter. You start depreciation from day one, do a cost segregation study, and now you can claim 100% of those tax deductions that were accelerated, okay, in the first year. And this is huge because, like I said, instead of taking 20% or 30% or more of those tax deductions over a 5 and 15-year period, you're accelerating that. You can now actually take that entire amount in year number one. So potentially, you're going to be spending 20%, 25% down payment to buy a commercial building, and you can literally take a 20 to 30% tax deduction of that, you know, of that purchase price. The bank is buying the building for you, and you have a tax write-off in that first year of the entire amount. So it's a huge benefit. It's starting to phase out. It's going to phase out according to the tax law that is so far, you know, as now, unless something changes with the new administration, it's meant to phase out in 2023. So it's going to go back down from 100% to 80%, and then it's going to start reversing itself to 70%, et cetera, until there's no longer going to be any bonus depreciation. So now's the time to take advantage of it.
Yeah, I didn't know that. That means like buying frenzy.
Yeah,
to go buy some more buildings. Yes.
The next 3 years, you got to buy and take advantage, because again, even if you get extra depreciation, it will carry forward. You'll create a passive loss. Right. You can use that next year and the further year after that. But once you take, you know, after 2023, it's going to go down. You won't be able to use it.
And I don't know if you're going to cover this or not, you know, like later on, but I think combined with the new CARES Act, there's a lot to do with that, because now you can actually apply it. Let's say you racked up all these negative, you know, cost segregation, essentially depreciation, negative depreciations. You can actually retro applied it to 5 years before. And that's something new in the CARES Act, which we also had an episode to kind of cover it with our CPA episode number 6 on that. Yeah. Yeah,
that's huge. One of the things that they reinstated was net operating loss carrybacks, right? Like you said, that you can actually go back up to 5 years. And if you have any of these losses, you can go back and amend previous year's tax returns and apply those losses to years that you actually paid tax on in previous years, and literally get a refund check for doing that. Now that,
so that makes me feel a little bit better on the years I feel like wasted staring at negative K1s, you know, in the past years when I didn't apply for real estate professional. But now it seems like there's a way for me to harvest that.
Yeah, definitely. And like I said, it's also going to carry forward. So, you know, in future years, you're going to have all that extra depreciation. So again, this is an election. You can only do this once you've done a cost segregation and already allocated, you know, what are those faster lives, and anything under a 20-year life depreciation, you can claim all of that in year number one, or you can just take that regular cost segregation. So you have the choice. And when we do a cost segregation study, for example, we always prepare both types of schedules, and you can basically pick and choose. You know, you can't go back and forth, because once you choose one thing, you have to go with it, you know, all the way down in the future. But at that one point, the first time you're doing it, you can then go ahead and choose, should I do bonus depreciation or the other way? A couple of things that this does not apply to is a 1031 exchange. Okay, it has to be a totally new acquisition with totally new capital. And it is not allowed for something that's buying and selling in the same year. Okay, so this obviously does not apply to flipping properties, because flipping properties anyways does not have depreciation. So this is not referring to flipping properties that buy and sell in the same year. It's referring to a rental property that you intended to buy it and keep it, but you actually ended up selling it, you know, in the same year. Rental properties are totally different than flipping properties, because a flipping is, and I know a lot of people get involved in real estate and fix and flips and stuff like that. That's considered ordinary income, because that does not have the benefit of depreciation. So it's very important, if you are doing flipping and you're doing, you know, these type of things, you should also diversify to have rental properties so that you can also take advantage of those deductions. Because again, if you're spending your time buying properties and, you know, doing renovations and flipping them, guess what? You're a real estate professional. You have those hours, you have that status. Now, having that status and not using it is probably like the worst thing you can possibly do. It's like, you know, it's like you having a laser beam and you have no idea what it is. You just like, you kind of use it as a paperweight or something. You know, you have the tools, you should try to use it.
So I want to kind of dive into this question a little bit. It's one of the questions I have and often comes up with from our investor. So then in the case of fix and flip, I always say fix and flip or W-2 are getting taxed the worst, because it's ordinary income rate. Mm-hmm. But in the fix and flip case, like you said, they are real estate professional. So if they passively invested in a deal, like kind of goes back to passive investment versus active investment, do they then get a bonus depreciation from there? So could someone be like, my main business is fix and flip, but on the side, I'm going to, I don't do anything else other than passive invest. Would I be able to kind of benefit from that in terms of cost segregation?
Yeah, so it depends. As long as you have the hours in your own properties, because you have to have a certain number of hours in your own rental properties as well. It's not enough. And it has to be rental property. It cannot be flip property, because I could be working, you know, 40 hours a week on the flip, but all I do for rental holding is that these passive investments. So that would probably not apply. Right. Right. But to that point, once you do have that and you do have those hours, then you could, in fact, go and take the passive syndication as passive investments and use those losses to offset your income, because you're already a real estate professional in that case. Got it. So then the strategy to diversify, maybe stop flipping so many. Maybe if you're flipping 24 units a year, you want to maybe take 12 units and do a BRRRR strategy, which is essentially holding a longer term. That will for sure qualify with the 500 hours over there, because the construction, all that stuff is linked to that. Maybe you only need to hold 4, right? And then you also do passive investment, because you're like, flip is where I make most of my money. But to kind of get the best of both worlds is you got someone else working for you by doing passive investment, and you own a few of your rental property that you're already flipping, doing BRRRR. And then the flip business by itself. And then now you can kind of take the maximum advantage of the tax. Yeah. Yeah, absolutely. Yeah. And I know a lot of people doing that they're, you know, literally trying to invest into syndications, especially like towards year's end, so they can, because they are the real estate professional and they want to get those tax deductions. So yeah, it's definitely worthwhile to do it that way. Gotcha. Cool. Well, thank you. Yeah, so let's talk about when is the best time to do a cost segregation study. And again, a lot of this, we haven't touched so much upon the passive investor yet. I do want to touch on that a little bit shortly, but I want to finish up just understanding the basic concepts of cost segregation. So one of the things we have to understand is you don't have to do this immediately. It can be done really at any time that you're owning a property. However, most people, in my experience, try to get this done in the first year. And especially now with the bonus depreciation, which you can only take advantage of in the first year, they want to do it in the first year so that they can get those losses and use them, carry them forward. So in fact, a lot of people reach out to us while they're still under contract on a property, and they want to see what's my benefit going to look like once I acquire this building, once I go ahead and put it into service, what's my tax advantage going to look like at that point. So one thing is when you acquire a building, you can do immediately. Now, when you go ahead and do a renovation, you can actually get double benefits because you have the cost of the building when you buy it, and you're allocating that and taking the entire cost segregation on that. Now, when you go ahead and renovate, whatever money you add back into the building, that money is depreciated. Okay, you're capitalizing that money, you're depreciating it. Now you can either depreciate on a long schedule, like regular straight line, or you can take those tax deductions over a shorter period of time with cost segregation. So you can, again, you can double dip on that because not only are you now taking the property as is when you buy it, you can actually now, whatever money spent on that in the renovations, you can take that at a faster rate as well. New construction is a great way to do it as well. If you're doing new construction, you can for sure get cost segregation on that. However, something a lot of people don't know is that you can do cost segregation as a look-back study to capture those deductions that you missed in previous years. And you can do this without actually amending any tax returns. Okay, this is a 3115 form that is a method change. You're changing the accounting method. And this is a form that we fill out for our clients at no extra charge because it's a little bit complicated for most CPAs. And this allows you to take any cost or any tax deductions that you missed in previous years. So think about this. Let's say you, in our example, we were talking about the whole time, $200,000, okay? Extra deductions. You didn't take those. And now let's say 3 years has passed. And over 3 years, you should have been taking an extra $40,000 each year. So you have over 3 years, $120,000 that you missed out on because you were just taking straight line depreciation. You can go and do a look back study, okay, getting those deductions. And in the first year, you can now get a huge chunk of that $120,000 now. So it's similar to bonus depreciation in that regard, that you can go ahead and take those tax deductions that you had missed and take a huge amount in 1 year.
That's awesome, because I think you just reminded me on a few of our projects. One of the projects, we had a building burned down before we take over the property. So our plan was to reconstruct that building using insurance money. Thank you, insurance money, and potentially create a different building. So we already did a cost seg with you guys, but when we build a new building, maybe it's time to contact you guys again for that.
It's a good question you ask. If you are using insurance money, you may not be able to take.
We have another building that we're building, not using insurance money. Yeah.
Okay.
Yeah.
So great. Yeah. But the money used for insurance money, the building used for insurance money actually may not be able to claim depreciation on it.
Okay. That's good to know. And then if we are doing a lot of renovations, so one other building that you guys did a cost segregation on, in Phoenix, first year, we actually weren't able to do anything because our seller decided to do us a favor by renewing everyone before they sold us the property. So we couldn't do anything to that building for about 4 or 5 months until the new year comes around. That's when we did most of the updates. So I guess after we did updates is when we have you guys come in and take another look, right? Is that the right timing?
Yeah, exactly. Once the updates are done, then you can take those, that money that was spent, and you can, put that, allocate that within the depreciation schedule.
Perfect.
Okay, awesome. So here's a little example. I mean, we talked about cost segregation, but most people talk about cost segregation, and especially if you're only investing in one asset class, you're only thinking about that asset class. You're thinking about multifamily all the time, and that gets a lot of the limelight. However, all types of commercial properties can benefit from this. And there are some that have even more benefit than apartment buildings, because there's a lot more of those assets in the building, and certain types of, stores, especially like a grocery store, a shopping center, for example, may have a huge parking lot. parking areas. The whole parking lot, that pavement has a lot of value to it because that's land improvements. And so that can be accelerated. Another great example of land improvements, I mentioned golf courses, but is mobile home parks. As you see at the bottom over here, that literally goes off the charts. Because when you are owning a mobile home park, oftentimes you don't actually own any of the homes. The tenants own their own homes, and you just own the park, which means you own the pads, the concrete pads, and the roads and the landscaping and all the stuff that goes around the property. That's all land improvements, and you can take a huge amount of that. And again, with bonus depreciation, you can take that all in year number one.
Yeah, so we actually have a question from the view over here about the mobile home park, because he has a mobile home park that I know of. That he owns majority of his home though, with a gain of 1.4 million. Should I do a 1031 or do a cost segregation? Do you have like a suggestion to that?
I suggest he kind of reach out to discuss a little more details, because it's kind of too few details to get into that. But I will say two things. It's not necessarily a choice. Should I do 1031 or do a cost segregation? The question is, what's going to benefit you in your specific situation? Doing the cost segregation will create these huge losses for you. And again, mobile home parks, literally, if you can see on the chart over here, oftentimes it's over 50%. Okay. And I've seen all the way up to 70 or 80% of the actual building costs. And that's when there's no park-owned homes whatsoever. But the property cost, okay, the purchase price can be a huge amount of that as a first-year bonus depreciation tax deduction. So if you need those tax deductions and you can use them, certainly use them. A 1031 is not mutually exclusive. In fact, you can do the cost segregation, and then afterwards, you can do a 1031 if you want to exchange it into a new property. What that will do is that will just reduce your basis, okay? When you do the 1031 exchange, you're not starting a new basis, a new depreciable basis in the new property like you would in an acquisition. If you buy a building for $1 million, your depreciation is $1 million, right? Minus land. However, if you're doing 1031 into a $1 million building and you already depreciated 500,000, your new basis, your new depreciation in the second building is only going to be 500,000. So that's the one difference with 1031s, that it doesn't carry over. So there's never not necessarily a, should I do this or that? It's really going to depend. And, I urge you to
do both. The answer is like you can do both.
You can do both. And if it's going to benefit you in that situation, you should definitely look into what the differences would be, doing one or the other, or potentially both.
And Yonah, you mentioned before with the 1031 exchange, you did mention that it couldn't apply to it. So is that meaning that when you did a 1031 exchange it into a property, then you do a cost segregation, then the amount doesn't really matter?
Right.
Would it still go and offset the basis though? Like if I did, increased on my second property that I 1031 into, which I did a cost seg on, but when I sold that property, does the cost seg ever plays into that?
Yeah, if you do a 1031 exchange into a new property, you cannot do a cost segregation, a bonus depreciation. You can do cost segregation, you just can't take the bonus depreciation on it.
Gotcha. So the bonus is essentially it's a wasted. You would just do a cost segregation, but it doesn't really matter. So at one point, it would never offset any base, even on your second property. That let's say you did an improvement and you made more valuation, could that be applied to it or no?
If you did more improvements and you did new valuation, no, that does not apply. Meaning, I thought you were saying new, if you're just doing improvements, but no, new valuation does not change anything. The basis, the only time the basis is changed is when you have an acquisition, okay, or a capital expenditures. When you're spending money on it, that money can be added to the basis. Like a refinance and reevaluation will not change the basis.
Gotcha.
Change that amount that you can depreciate. But it's a really good question. Really good question, because a lot of people are confused about that. Like, I bought a property, and it's kind of upsetting sometimes. You buy a property that's really undervalued, you can only claim depreciation on the amount that was spent. So a guy today, literally, he's like, yeah, I just got this, it's $5 million. I just got it appraised for $7 million.
Right.
I said, sorry, your depreciation is going to be based on the purchase price, not on the appraisal.
Yeah. Yeah, because we have a property that we actually 1031 exchanged it into, did a cost segregation on there. I trust my CPA is doing the right things over there moving forward. But yeah, he kind of commented on like, hey, this is kind of like a wasted. But the hours that I use for that does qualify me as registered professional. So
Okay.
Cool. Great.
Well, yeah, and if you did do that, you probably did it into a tenants in common structure.
Correct. I did. Yeah.
Which, you know, the sponsors may very well have done a cost segregation study, and each tenant in common is going to have their own basis.
Right.
So you can choose to use, you know, they could have done a cost segregation and taken bonus depreciation on their portion.
Right.
And then you could have taken, you know, just regular cost segregation.
Depreciation. Yeah. Yeah. I think that's what we elected to do. Yes. Yeah. Good point. Because I still have the depreciation. It just elect to have it now versus future. Yeah.
So here's a little case study over here. There's a property out in Waxahachie, Texas. I think it's somewhere north of Dallas. So this is a great property over here that was purchased for $13.5 million. Nice little apartment community. Without cost segregation, the annual depreciation would have been $417,231. Which, you think about it, that's awesome, right? That's huge. You take that as a tax deduction. That's awesome. However, on a $13.5 million building, the net operating income was a little over $1 million, which means they were still paying taxes on the remaining $600,000. Okay. Now, so it's great to have that deduction, but what about the extra $600,000 taxes, income tax? You're going to pay, you know, a few $100,000 of income tax. But comes along cost segregation, and how we did is like this. Here's the breakdown. And this is a little bit less than normal. I'd say this is really on the lower end of multifamily properties. You'll see the percentages, the numbers, it's usually a lot more than this. But I use this as an example just to show you, even on the minimal, even on the smaller properties where there's less allocation, it's still going to be extremely beneficial. So here we allocated 15% to land, a little over $2 million. We're left with about $11.5 million. Is still going to be the depreciation. About 17% of that goes into the 5-year property. And again, like I said, it's usually over 20%, but 70% is still pretty good. $1.9 million of extra depreciation in the first 5 years. And the 15-year property, against the land improvements, landscaping, the fencing over here, right? These steps, all that stuff is depreciating on a 15-year schedule over $600,000. Add that together, we have over $2.6 million of accelerated depreciation. Guess what? To bonus depreciation, that $1 million income was now reduced to zero, right? Income tax liability, which means in the first year they're paying zero taxes. Second year also zero taxes. Third year also very little taxes, because again, you have the $400,000 of regular depreciation. Okay, so this first 3 years was literally zero income tax whatsoever. And here's where I want to step in and say that, you know, oftentimes people ask me, is it worth it? Should I do cost segregation, right? And sometimes the answer is, you know, it depends on your situation. Because if you're one guy, you're one gal property, you buy one property and that's it. You're going to hold that. It might be beneficial to you to just do regular straight line depreciation and take those deductions equal for the rest of your life. However, as I mentioned a few slides ago, that, you know, time value of money, it's, even if you're going to do one property and you're going to hold it for 39 years, it's still going to be worthwhile, because the time value of money, the government is basically paying you to do cost segregation to take those deductions earlier on, which is pretty cool. But if you buying more than one property, it's basically a no-brainer, because you buy a property this year, another one next year, 2 or 3 years from now, another property, you're going to take those tax deductions from property A and use those to offset the income from property B and all your properties. Because again, depreciation, even if you're not an active real estate professional, even if you're a passive investor, the depreciation goes against all of your income, all of your passive income. Okay, so you have multiple properties, the depreciation goes against the multiple income from those properties. So even if you can take the bonus depreciation from one property and use that to offset the income from all of your other properties. And this is where I want to, you know, mention again about the passive investors. Because on this deal over here, $13.5 million was not bought by one person, it was bought by a syndication. A lot of people invested in this deal. Everyone had a different stake in ownership, okay? According to their equity of ownership, according to, you know, how much money they put in, et cetera, where their, you know, shares were in that deal. Everyone gets depreciation. Again, even if you're investing from your retirement account, right? Again, you're going to get that allocation. You just can't use it if you're a retirement account, but everyone gets it. And this is given to you in your K-1 tax return. In that return, in that document, Form K1, shows you what your income and what your losses are. And if you're a passive investor, it may show you a loss. Like Elisa, you're talking about having these K1s, these negative K1s. What does that mean? How does that translate? What that does is it has the investment, the return on investment from your property at the very least was tax-free. Okay, it may create a negative and may create a loss, and you may not be able to use that. However, don't forget, show me any other asset class, any other type of investment vehicle in the world where you can get returns on that investment and those returns are not going to be taxed.
Right. There's very few of these, you know, like
Yeah.
maybe oil where you buy barrels and drill rights.
But now,
that's
right now with what's happening in oil is
right. There's investment risk, of course.
There's risk.
Yes.
There's risk in all investment, of course.
Separate concept there. Yes. Yeah.
And another thing to understand about the incredible tax advantages here in real estate is not only are you getting these negative K1s, you're getting this return on investment that's tax-free. Name me any other type of investment vehicle where you can actually borrow money from the bank and the bank is going to pay for that and you get the tax deductions on the bank's money. Okay, again, you buy $1 million building and you only put down $200,000 to buy that building. The bank pays 80%. You're paying 20%. You get to take the tax deduction based on the entire $1 million. So you're getting the return on that investment, and it's not even your money invested in it, which is, and you're getting the tax deductions on all of that, even though it's not your money invested in the first place. So that's another huge thing about real estate that, I just wanted to share.
So I don't know if you're taking a question over here. There is a question along that line. Is passive depreciation can be used to write off stock capital gains or dividends or interest?
No. So stock capital gains, unless you're a real estate professional. Okay, if you're a real estate professional, again, you can use your non-passive losses, right? Can be used to to offset all of those deductions. However, if you're not, those, even though they seem passive, right? Stocks and dividends, they seem they're not. They're not considered. They're still considered active. It's a different category. Therefore, you cannot use these depreciation deductions to offset that. The one other thing that does qualify as passive, I believe, are royalties. So if you have some sort of royalties, if you're
that's why Kevin the Shark always asks for loyalty, because that's a passive, right? That's probably why, and he has real estate. Yes. Yeah,
it's a good idea.
Yeah. We did have another question. I'm not sure. Maybe you can answer this. Can you talk about aggregation of your properties?
Sure. Yeah. And again, this is probably a good question for your accountant, but aggregation of your properties just means that you can, this goes back to our question on the real estate professional and having those hours. So if you make that election, and again, you really should make this election, it's a one-time thing you have to do one time. I think it's called the 9 election, something like that. You should, that allows you to then aggregate the hours from all your properties, which allows you to only have to work a certain number of hours on each property, and that all applies to the whole bundle together.
Gotcha.
Which will then allow you to take the tax deductions, obviously from all of them.
And that's also a CPA question. So Mark, I would encourage you definitely checking up on your CPA with this.
Yeah, 100%. Okay, what should we be looking for in a cost segregation study? This is directly from the Audit Techniques Guide. So you want to go to the tax code, you want to go to the IRS website, check out Cost Segregation Audit Techniques Guide. I highly recommend this. This is great reading, especially if you're an insomnia. This is wonderful, wonderful reading over here. And these are just the head categories. There are 13 principles of, a quality cost segregation study, which shows you what needs to go into this. This is definitely not something that can be done just off the cuff. There's so many things that go into this, and this is why you need to hire a firm that specializes in this. And even accountants cannot do this on their own, because they're usually accountants that try to do this on their own are not following these principles. And unfortunately, they could get in trouble if they're ever to be audited. So again, it has to be, there's the expertise, the experience. There's also a whole methodology. There's a whole numbering system, nomenclature. There's a whole, we create a report, Madison SPECS. It's, 90, 100 pages long, and it has all this detail into it. all the case history of all the different assets, pictures obviously that go into, showing someone was actually there in the building. So these are things you want to make sure that you are taking into account, and not just, hiring someone who's going to tell you, yeah, I'll create a depreciation schedule for you, but actually, back the work up for them.
Yeah, I was just going to show the audience like maybe a sample of my report at the end of this.
Sure. Yeah, I can actually show, I can share my screen also. I have a number of sample studies over here I could show if you want. But if you have yours, by all means.
Yeah. But I wanted you to kind of finish the presentation before.
Yeah, this is basically it. The one thing I want to just say about, selecting a company, and this is just talking about the advantage of having engineers and accountants and having in-house, and, make sure they give you a feasibility analysis up ahead, and make sure they have a, audit defense. Because the last thing you want to do is that if you're ever to be audited, God forbid, I don't wish anyone should be doing that, but if you do, you want to make sure that it's going to stand up to an audit. So you want to do, just a little bit about us. We're the best, and that's it.
I can attest to that, because every time I was just telling Yonah before we joined here, every time we try to go the other way and some of our partner brought over someone else that they trusted before, so what they do is they actually give us a quote on what the cost segregation may look like. Usually it's on the conservative side, because they usually always work the numbers, so it's better. And then we compare with another company's cost segregation quote, and it's usually dwarfing. Like, they will save us way more money than the other guy maybe was saving a little bit on using them. But, at the end of the day, like what we try to do over here, if you can save me like tens, thousands of dollars in tax, I don't care about paying someone else, just additional $500 or something like that. Well, I don't care about paying someone less $500 or something.
Yeah.
Right.
No, exactly. And I think it's really important to note also just the expertise. And I kind of scrolled over those pages, and I probably shouldn't have, because we really are not just the largest cost segregation firm. We're doing the most volume in the entire country. And we did, in 2019 alone, we did over 2,500 studies across the country. But we have, the biggest staff, and we have probably the most experience. So we've done over 16,000 of these studies. We've been doing this we've been open in business for 15 years, and our accountants and some of the engineers have been in the industry for decades. So you really have some of the world's experts. And the only reason I can even call myself a cost segregation expert is only because of those people that, work in our company that I've learned from, and that they're really doing the work. They can't necessarily give these presentations, but they're doing the real job and doing the work, and I've learned from them. So I want to, give them the proper recognition for, who they are and what they've done, and basically taught me everything I know. So this is something that you should really, look into. If this is, again, any property, we mentioned this before, but, $1 million mark is obviously a no-brainer. You talked about the tax benefits there. Even under that, it's something worth reaching out. Yeah. Getting a quote, like you said, getting that free estimate, so you can even see what those potential tax savings would be. Yeah.
And I would say the rule of thumb, like one other question I had for Yonah was like, hey, at what point does it kind of make sense? Because these studies kind of cost money, right? And I think by my back to napkin math, it was like if your property was more than 500K, it start to make some sense, given the cost is still pretty very efficient with Madison SPEC, the ones that we've seen. And so if you have more than 500K in your property, if you estimate that's more than that, it may be worthwhile reaching out to.
Definitely.
And I did have a question over here from a audience. I know that, we're at the time. I don't know if you have a few more minutes to answer a few more questions over here. Want to be kind of respectful. Sure. We have one question over here. If I use segregation to accelerate a large amount of depreciation, wouldn't that lower my cost base and a larger capital gain when I go sell or 1031?
Yes. So it's an excellent question. You're going to lower your cost basis, and you're going to have potentially large capital gain, but you can, if you are, and this is really why it has to do with the strategy for every individual. Okay. So if your strategy is going to help you upon the sale to mitigate those tax, risk later on, and when you have the depreciation recapture tax later on, and you can get around that by either doing a 1031 exchange, or you can get around that by other tax strategies, then it's going to be worth it for your situation. But it's an excellent question, because yes, the segregation is going to lower the cost basis. And when you go to sell, you're going to have a larger capital gain, depreciation recapture tax.
Gotcha. The other question is a little oddball. Is there a specific title for the engineers that do the cost segregation study, asking for my son, who is an electrical engineer here? I'm guessing he's implied he wants his son to work for Madison SPEC. Yeah.
Yeah, there is not really a special title. It really has to do with just the training and the experience. So I know a number of our engineers, and we have 16 engineers that work for us around the country. And a number of them have had different experiences in engineering. So it's really just the training. It has more to do with constructional engineering than any other type, but yeah, it definitely can be beneficial if you have that construction training.
I'm going to share a report over here. That's one of the projects that we did with this building, just to kind of show, like, nobody needs to zoom in on the numbers and et cetera, but this is like a 90-page report that they prepared for us in terms of cost segregation. I don't even know half of it. All I do is I lob it over to my CPA, and then he comes up with a number, whatnot. But I think there was a calculation more up in the front. What is that?
Like page
5 years,
16, 19, something like that.
Something like that. It's so long to scroll through, but just to kind of show like the thoroughness of the information that goes in, they take a whole bunch of pictures of the properties, as we kind of go over it.
Page 14.
14. Okay. So page 14. So this is the summary report, and which is usually the number that I kind of zoom in to see what we can kind of benefits from there. There's usually a 5-year, 15-year report. That's what I usually use on my slide when I'm creating a syndication slide or whatever. This is a property that we own, not syndicated. But essentially, I just want to kind of show the thoroughness of the reports over here. There's like 86 pages of this. Half of it, I have no idea what it says. Just give it to my CPA on that. Cool. So I think we have a lot of questions to answer here. I did have a few other questions over here that I collected for folks who cannot join. So specifically, if one person who has bought the property 4 years ago, could they do a cost segregation? And would they be able to kind of recapture what they lost? Because their CPA is not very versed. So essentially, they don't even talk about a cost seg. Actually, 90% of CPA we kind of talk to, or our investor talk to, they do not talk about cost seg at all. And some of them kind of frown upon it for whatever reason I don't understand. I don't think they ever did one. So the question was, someone has bought a property 4 years ago, a 19-unit property. They have kind of not done cost seg or anything with it. Is it something that they could do retroactively?
Yes. Yeah. So we touched on this a little bit earlier. There is something you could do retroactively. You just want to make sure to look at your depreciation schedule and see what has been done up until this point, how much depreciation has been taken up until this point. It's something I'd be happy to look at and, kind of see if it would even be beneficial. But it can be done. Again, like I mentioned before, this can be done without amending your previous year's tax returns. What we're doing is just an adjustment, and going forward saying, I'm taking an adjustment, and all the accelerated depreciation I missed, I can now take in this year. And then going forward, I'm going to be using this different method of cost segregation to depreciate the property. And that's all we need to do.
Got it. And then what type of asset gets cost segregation, like a high number of write-offs? Like, so these are kind of like questions from syndicators where they like, hey, is it like a newer asset we should expect a bigger cost segregation? Obviously, the more work that you're going to do with it, you're going to have a cost segregation, but usually you guys do cost segregation up in the front. So if we did do extensive update to it, should we wait until we finish that and ask you guys to do it? I guess there's a lot of questions over there. But I guess the first question is like, what kind of asset do you see get most with apartments, like newer or older, right?
Yeah, so there is a small percentage of adjustment based on, when the actual property was built. But again, as I mentioned, the main depreciation, it's based on the purchase price. And then the engineers go in and actually do it. And one of those, things, many of those papers in the, the report that you kind of glossed over, some of those is actually adding up the real useful life versus the tax useful life. So there's a certain kind of small percentage of, and it's beyond me because I did very poorly in calculus, but it has to do with the just adjusting. That's why I'm not an accountant, but I just play one on TV. But really what we do is looking at the difference between the real useful life versus the tax useful life. So if it's a brand new property, it's going to have a little bit more, the newer property is going to have a little bit more depreciation than if it's, a much older property. But again, it's very slight. It's in the less than 1%, of difference between those things.
Gotcha.
One other thing that would make a difference, and the things you really want to look out for, are garden style apartments. The more landscaping and pavement and that kind of stuff that's in there, and also the types of appliances and the types of actual furnishings in the building.
Got it. And then oftentimes I've done this with David before, contesting them too. The higher usually the property in a better location, it seems to be less because the location, the land value itself, which is not depreciable, is usually taking a bigger proportion inside of that building cost, the purchase building cost. So we've noticed that on properties that in good location, we get a slightly lower cost seg. And I think also what time to buy to get most of the cost segregation. I'm guessing in the beginning of the year, you're going to be having a lot more opportunity cost seg because you're doing for a whole year. So therefore buying in the beginning, maybe optimizing for that versus on December 20th when you close the deal. Right?
So it's interesting. Normally depreciation is prorated, which means that to the day of the year that you buy it, which means if you buy a building in December 27th, right, you get 4 days of depreciation. And buy a building for $1 million, you only get a tiny percentage of that you can actually take. However, and that goes for depreciation across the board. However, when you're doing bonus depreciation, that's the only time when proration gets thrown out the window. Right. Because even if you buy a building on December 31st, you can literally take the entire amount of 5-year and 15-year depreciation in that year, in that first year, which is incredible. So in terms of your question, you'll get depreciation for that first year. It's prorated. Every other year past that, it's going to be, a full year's depreciation.
Gotcha. And when does it, we talked about the active income offsetting it. We talked about break-even point, owner property less than, and what it makes sense for you. Always makes sense to do a cost seg or deal. We talked about these ones too. Can you kind of explain about cost segregation on a development project? How would that work? When is the best time to have you guys come in and look at the project and do a cost segregation?
So development is, cost segregation only applies and depreciation only starts once the property is placed in service. Okay, placed in service means when you're buying a property, it means when the acquisition happens. When you're developing a property, and again, development, your depreciation is only going to be relevant. I didn't mean to rhyme there, but it did. It's only going to be relevant if you are holding that as an investment property. Now, if you're developing it to sell it, obviously, okay? I want to just make that clear. But if you are developing it to keep it as a rental property, it's considered placed in service when it's ready to be rented. Okay, so you don't necessarily have to have all the tenants in to start depreciation, but it has to be ready to go, ready to be marketed to be rented out. So at that point, that's when it's going to start. Therefore, it may not make sense at all to get someone involved for a cost segregation or development deal until much later on in the process.
One last question over here. It sounds like a little loaded question, but as cost segregation bonus depreciation goes, when you take it, at some point, IRS is always very smart. They'll have a way, one way or the other, to catch up to you, right? So when you're selling it, the ones that you're not using, I believe there's a particular penalties with the depreciation that you took up in the front, right? So for the remaining of it, I think you have to pay back a 25% or whatnot. But to your point, just kind of tee it up, is how then do you kind of avoid that penalty, right? Or does it make sense to do a cost segregation because there's a penalty in the end?
Yeah.
Yeah.
There is, like I mentioned before, there's something called depreciation recapture tax when you sell a property. This is, and obviously depreciation is meant to incentivize you to help, you're helping the economy, you're getting these deductions. However, when you sell a property, not only do you have capital gains tax if you made a profit on that, but you have depreciation recapture tax, which means you now have to go and pay a tax, 25%, rate on depreciation of the amount that you took. So usually that's going to be anyways beneficial between the spread of what you would have paid had you just paid your income tax up front versus paying the depreciation recapture tax on the sale. But there are ways around that as well. So it's not like you have to do this. Now, first way is, like we spoke about, if you do a 1031 exchange, right? You defer capital gains tax, you defer depreciation recapture tax. You just keep pushing it down the road. The second way, and there's really more than one way, but the second way is that if you're a real estate professional and you have these passive losses, you can literally have passive losses from one property to offset the capital gains and the depreciation recapture tax from the sale of a different property.
Right.
So it's all about playing the real estate game to maximize these tax strategies and not just looking at it in a bubble. Like, if I just have this one property, how am I going to get hit? Again, each person, according to their situation, should discuss this with a tax advisor. What's going to be the best business plan for me? More times than not, most often, cost segregation is the way to go.
Yeah. Because I think I want to kind of comment on that one a little bit too. Is I see the cases where people will say 100% time I will take a cost segregation bonus depreciation. Of course, that their wife or whoever is a real estate professional. The reason why is they're doctors and they're paying a 39% tax bracket. And sure, they can pay the recapture 25%. It's still saving you like 14%, right?
Exactly.
And then, of course, there is a way to kind of defer it. And the other thing is about 1031. I want to make a comment over there because one of the things that we mentioned was how this can be a replacement of a 1031. Because 1031 have the 45 days requirement to identify next property. But with a cost segregation, you have that whole entire calendar year to potentially find your replacement cost, right? In that aspect. So it gives you a little bit more flexibility as well.
Yeah.
Cool.
And another point that, is often overlooked as well, in a failed 1031 exchange, you could potentially in the same year buy a property and have, huge bonus depreciated passive deduction, passive losses that can offset that capital gains tax. So it may not be the best strategy because, it's using those passive losses to offset a lower income tax rate, a lower tax rate of the capital gains instead of carrying them forward to next year, offset a higher tax rate. However, just pointing out that there is a strategy, there's a way to actually go ahead and do that. Gotcha.
Cool. Well, thank you so much, Yonah. These are all the questions I have, took notes on from people asking me questions over the weekend. So the session is recorded. Can I share the slides that you presented during the session today? And then also include your information to send it to our recording. So you have to be registered to receive our recording and also our 400, 500 some people on our listing as well. Thank you so much for being on our show today. And we definitely appreciate your time, Yonah.
Yeah. Thank you, Lisa. I appreciate you reaching out. Happy to do this.
Thanks. All right. Have a good evening. Thank you.
Bye.
Bye.